Meet Ryan and Steve. They are both 32 years old. They live in the same American city. They both earn $80,000 every year, and somehow they saved exactly $80,000. Financially, they look almost completely identical, but personality-wise, they couldn't be more different. Ryan loves stability. He likes knowing exactly what comes next. He wants a place permanently belonging to him, a garage for tools he may never use, a backyard he can irrationally protect. Steve thinks completely differently. He values freedom and flexibility above everything. He likes keeping every possible option open. He doesn't know where he'll live next, and honestly, he likes that uncertainty. Eventually, their personalities create completely different decisions. Ryan decides to buy a house. Steve decides to keep renting. Now we're following them for 20 years. Every mortgage payment, every rent increase, every repair bill, every investment contribution, and every dollar potentially earned from investing. Then we'll discover who actually ends richer. Let's start with Ryan. Ryan finds a 3-bedroom house. It has 2 bathrooms and a small backyard. The house costs $350,000. Ryan puts $70,000 down immediately. That's exactly 20% of its price. He needs a $280,000 mortgage, but buying requires more than just the down payment. There are closing costs, inspections, taxes, and fees. Let's assume those costs total another $10,000. So Ryan spends his entire $80,000. $70,000 goes toward the house. $10,000 disappears before moving day. Ryan takes a 30-year mortgage at 7%. His principal and interest payment is roughly $1,863. But that's definitely not his complete housing cost. He also pays property taxes every month. Then there's homeowner's insurance, and eventually something inside the house breaks. So Ryan budgets money for maintenance too. His initial monthly housing cost reaches roughly $2,653. Now let's look at Steve. Steve rents a similar 3-bedroom house nearby. His starting rent is $2,000 monthly. Immediately, Steve spends $653 less every month. Steve still has his original $80,000. Instead of buying property, he invests it. Then he invests that $653 monthly difference. At first, Steve's decision looks incredibly attractive. Similar house, lower monthly housing cost, and money continuously invested. Someone will immediately say something familiar. Steve is just throwing money away. Ryan's mortgage payment builds equity. Technically, that's partially true. Mortgage payments aren't entirely equity. In the early years, interest takes a huge portion. Ryan's first mortgage payment barely builds equity. Most of that payment simply covers interest. Then come taxes, insurance, and maintenance. They're simply costs of owning his home. Now let's jump ahead 3 years. His mortgage balance has fallen somewhat, but not nearly as much as expected. He has paid down roughly $9,000 of principal. Let's assume 3 to 4% annual appreciation. His home could now be worth around $382,000, or potentially closer to $394,000. That gives Ryan meaningful home equity. But Steve has also been investing. His original $80,000 has continued compounding. His monthly contributions have also grown. After 3 years, they're surprisingly close. Ryan has home equity. Steve has investment assets. Ryan controls his house completely. Steve can move whenever he wants. But now something important begins changing. Time starts affecting both strategies differently. Ryan's mortgage principal and interest stays fixed. Steve's rent doesn't. His landlord raises the rent gradually. $2,000 becomes slightly higher, then higher again, then higher again. It's almost like rent discovered compound growth. Property taxes can rise. Insurance premiums can increase. Older houses can demand bigger repairs. So neither strategy stays completely static. Now let's jump forward to year 10. Ryan is 42 years old. His house may now be worth substantially more. Depending on appreciation, perhaps $470,000 to $518,000. His mortgage balance has fallen somewhat. That leaves Ryan with considerable home equity, but maintaining that house wasn't free. Over 10 years, repairs have appeared. Now look at Steve. His original $80,000 has compounded dramatically, and he continued investing his monthly savings. However, those savings gradually became smaller. Why? Because his rent kept increasing. Still, his investment portfolio may reach around $290,000. At year 10, Steve can still be ahead financially, but there's an important psychological difference. His rent is now approaching $2,700 monthly. Ryan's principal and interest remains around $1,863, and this is where long-term ownership becomes powerful. Now let's jump forward to year 20. Ryan and Steve are now 52. Ryan's house may be worth around $632,000, or potentially closer to $767,000. His mortgage balance has fallen significantly. That leaves him with substantial home equity. Steve's investment portfolio has also compounded. His original investment alone becomes much larger, and his additional contributions continue adding wealth. Under these assumptions, Steve could reach around $750,000. So after 20 years, Steve may have higher net worth, but their wealth looks completely different. Steve's wealth is liquid. Ryan's wealth is mostly inside his house. Steve can sell part of his portfolio. Ryan cannot sell 8% of his kitchen, at least not without confusing future buyers. But Steve has another problem. His rent never automatically disappears. After 20 years of increases, rent becomes expensive. Ryan has only a limited number of mortgage years remaining. Eventually, that mortgage can disappear completely. Steve's housing payment doesn't have that finish line. He actually has to invest the difference every single month. Even when markets are falling, even when headlines predict financial disaster, even when everyone says stocks are finished, Steve still needs discipline, because spreadsheets assume perfect behavior. Humans rarely behave perfectly. That extra $653 can become restaurant bills. It can become vacations. It can become a nicer car. It can quietly become lifestyle inflation. That's one major advantage of home ownership. A mortgage can create forced saving. Ryan doesn't decide whether to build equity. His mortgage payment makes that decision automatically. The second issue is mobility. Imagine both receive amazing jobs elsewhere. Steve can simply move. Ryan has more decisions to make. He could sell his property, or he could become a landlord, but renting it creates new responsibilities. He could have a mortgage in one city and rent in another. If the property loses money, Ryan pays. Then there's concentration risk. Steve owns thousands of companies through diversified investments. Ryan owns one property, one neighborhood, one city. If that location struggles, Ryan feels everything. Steve can rebalance his portfolio. Ryan can't rebalance his neighborhood. Then there's liquidity. Steve needs $20,000. He can potentially sell investments. Ryan needs $20,000. He needs borrowing, refinancing, or selling. Home equity is valuable, but it's difficult to spend directly. So, which strategy is actually better, buying or renting? The honest answer is surprisingly simple. It depends. Buying becomes stronger when you stay longer. 7 to 10 years can make a huge difference. Transaction costs become easier to absorb. Mortgage principal gradually builds, and rising rents make fixed payments more attractive. Buying also becomes more attractive when prices are reasonable. One useful measurement is the price-to-rent ratio. Take the home's price divided by annual comparable rent. A $350,000 home with $24,000 yearly rent equals 14.6. Lower ratios can make buying more attractive. Higher ratios make renting increasingly competitive. But this isn't a magic formula. Mortgage rates still matter. Taxes still matter. Insurance still matters. Investment returns still matter. And personal circumstances matter enormously. Renting becomes stronger when home prices are extremely high. It's also valuable when flexibility matters. But there's one condition renters cannot ignore. They need to actually invest the difference. If they spend everything, the advantage disappears. And buying doesn't mean you stop investing. You can own property and invest simultaneously. Personal finance rarely has one perfect answer. Ryan traded flexibility for stability and leverage. Steve traded housing certainty for liquidity and flexibility. Neither decision was automatically smart. Neither decision was automatically stupid. The real question is much more personal. How long will you realistically stay there? And if you rent, will you actually invest? Those two answers can change everything. Because 20 years later, the winner isn't automatic. It isn't always the homeowner, and it isn't always the renter. The real winner is whoever follows their strategy. Ryan needed enough time for buying to work. Steve needed enough discipline for investing to work. That's the part spreadsheets often forget. Your financial strategy only works when you follow it. Because the biggest financial decision isn't buying versus renting, it's what you do after choosing either one. If this comparison changed how you see housing, subscribe for more simple breakdowns of complicated money decisions.